Good evening, everyone. Welcome to Tideway's autumn webinar. My name is Seymour Banks. I'm be hosting the webinar this evening, but providing the market insights and answering all of your questions, hopefully. I'm delighted to be joined by the founder of Tideway, James Baxter, and our investment director, Nick Gait. The purpose of this evening is really to focus on investment issues, both in terms of past performance, but also looking ahead at what the market risks potentially are and whether or not we can actually maintain what's been some fantastic performance year to date. For compliance reasons, as normal, I have to say that our opinions expressed this evening are personal in nature and do not constitute financial advice. So with that out of the way, we had an extraordinary number of questions for this webinar. Thank you very much indeed. What we've done is we've tried to use AI to order them in different sections. And so we've got an agenda, if you like to, starting with 6 different areas. But before we do that, we'd like a little bit of fun and test the temperature of people watching this evening in terms of their expectations for what is going to happen in the markets. And so we have a poll, and the poll is to find out whether or not you think there's going to be a market crash in the next 12 months. So if you'd like to press on your buttons, so we can try and get an idea of the balance.
We'll talk amongst ourselves while this comes in.
And the running commentary at the moment is it's fairly even, although expectations for market crash are slightly in the lead.
It's exciting.
Yeah.
It remains in the lead, and I suspect we're probably we're there. We'll end the poll at that point. We've got it's basically a 60-40 split. So that's good to know in advance. We'll see whether or not our investment commentators think exactly the same way or not. But that's certainly an interesting start. In terms of the agenda, as I said, we've organized it in 6 different sections, as you can see, hopefully on screen. I commented about the fact that we're going to be focusing on investment issues. So market risks and a potential crash. We'll be looking at that straight away. And that, in fact, was the subject for most of the questions we received. Performance and strategy, looking back at how Tideway's portfolios have done, respective to the market and also our peer group. Looking at the different asset classes, so fixed income, equities, and alternatives. And in terms of how we're constructing our portfolios. We'll look briefly at planning and tax issues, financial advice, but we're looking to do a webinar after the budget at the end of November. And so that will be the time where we really focus in on that and hopefully get a lot of questions in advance of that webinar as well. We have a few questions regarding Tideway and the business itself. So we'll be looking to respond to those directly, and some personal ones for you, James, there. Finally, we'll get the old crystal ball out and we'll try and look forward to the global outlook. And again, answer your questions, which we've tried to group as best we can. So with that as the agenda, we'll start off with market risk and potential crash. James, I think we'll start with you. When do you think a crash is going to be? As markets are looking expensive, valuation is the key issue here. Ironically, when we had our last webinar in April, it was just after the Trump tariff turmoil, and markets were falling quite dramatically. So we were worried about markets crashing then. Now we have markets serenely going upwards, and we're still worried about markets crashing. But anyway, James, what's your view on that right now?
Well, thank you, Seymour. Great introduction. And thank you, everybody, for doing the poll and sending the questions in. It makes our life a lot easier when we know what you're playing on your minds. And this was clearly by far the biggest issue that came up. And I think what's quite interesting is that whole Liberation Day was kind of like a dress rehearsal. So we got a feeling of what it's like to be in a market crash, although of course it all was over within a week or two. And as we see, we've had a massive recovery since. But I have used it as a good example talking to people because it was a great opportunity to think about your portfolio and whether or not you're comfortable with the risks as to how you felt as those days happened and the market started to crash. I mean, this week we've had, apart from the Tideway client base worrying about the crash, we've had the IMF worrying about the crash, the Bank of England worrying about a crash. We've had Larry Ellison last week, not Larry, Jeff Bezos telling us there will be a crash, and Jamie Dimon yesterday in Bournemouth saying how likely it was there'd be a crash. So clearly, there's a lot of people out there who think there is a bit of a problem, and that problem generally goes by the name of AI and what that is doing to share prices. There's been a lot of going back to the .com era, and I have, unlike Nick, who probably was still at school when the 1999, or were you born, Nick?
It's
not that young. It's not that
12 years old.
He was 12 years old, bless him. So he has no personal experience of the .com boom, but I actually remember it quite well. And you can see why people are going there, because it's tech again. The prices have been going through the roof. Just this last week, there's been quite a big melt up in some of the prices. But there are substantial differences this time round to in 1999. In 1999, it was the internet was the issue, which was entirely new to us. I mean, although it had been around for a little while, it had only been used a little bit, and then suddenly there was this revelation that it might get used in business and what would happen. And I remember, there was a .com starter every week, from pets.com to I was particularly involved with some people who were doing this online exhibition where we'd all have avatars and wander around an online exhibition as an avatar. Most or a great deal of these things came to absolute nothing, never made any money, and were proven to be completely poor business ideas. Of course, the internet went on to be a massive revolution for lots of businesses and has transformed the way we work, the way we buy tickets, the way we, almost the way we steer around the world. Everything has been changed by the internet. But who were the winners and the losers out of that were quite different to the one, all the startups. This time round, we have the hyperscalers, which is the big companies who are in the main, big companies like Microsoft, Amazon, Apple. These are companies who are throwing off enormous amounts of cash, very profitable businesses, piling money into AI. A lot of it through OpenAI is the company that gets referred to a lot. And it's OpenAI's commitment to people like Oracle that caused its share price to go through the roof, to AMD the other day that caused its share price to go through the roof. It is the spend that these hyperscalers are going to make on driving AI development, which is causing the price bubble. And in many cases, you can actually see, okay, the PE ratios may be at .com type levels, but some of these companies are actually facing a wall of business that probably justifies some of the price rises. The spend this year is about 300 billion. The talk is that this is going to accelerate. OpenAI has made commitments of almost $1 trillion, even though at the moment it only has a revenue of 12 billion. But money has been pumped into it, and there's high expectations. OpenAI, interestingly, is not a listed company. It's a private company. So if it goes badly wrong, we're not necessarily going to feel much from that. Microsoft owns 6% of it, but Microsoft shares moved by 5 or 6% in a week. So we're not too worried about that. What I think has got people's nerves on edge is that the fact that there's quite a lot of circularity. So we've had this classic example where NVIDIA, who are the chip makers, have invested in OpenAI, who places with an order with Oracle that then goes and places an order back with NVIDIA, and the cash is circuitry, which always feels very scary. But there is no question that this cash is being spent, and the businesses that are involved in the picks and shovels of AI are going to make a lot of money. The bits that worry me more are the companies, and dare I bring old Elon Musk into it, but the companies where they're relying on AI to transform their business models. So with Tesla, they're already saying this is not a car sales company. We're going to have robots. We're going to have driverless cars. And so they are expecting AI to deliver completely new business and revenue streams. And that to us feels very speculative. But in other parts of the market, we're not feeling like things are quite so elevated. and Nick will probably be able to comment, but some of our
Leave-
value
leave
managers,
something from you.
some of our value managers are feeling like there is quite good opportunity out there.
Yeah, just to add to that, high valuations alone they're a poor market timing tool anyway. So if you're projecting a crash in the next 6-12 months, I mean, that factor alone does not guarantee it. There has to be a catalyst there, like we saw earlier in the year with Liberation Day. There has to be something either known or unknown to us before that happens to make the market derate. So that's what I would add.
Yeah.
Add to
And that brings us back to Trump, Seymour,
It-
which I also think, Trump is in power. I think he leaves on, maybe you put this in their diaries, I think he leaves in January 2029. So we've got
a
another
long way away.
It's a long way away. And, I think that's what surprised Trump about the Liberation Day sell-off. No one was expecting the stock market, of all things, to sell off during a Trump presidential period. And I think, generally he's going to be pretty positive. I don't think he's going to want a major market debacle on his record. He might not be able to avoid it, but he'll definitely try and avoid it. So I'm probably a little bit less bearish than the Tideway community. I think it's 50-50.
Because I would say try and make a distinction between markets per se and parts of the market.
Yes.
Because, clearly the US dominates markets generally. Clearly within the US, technology dominates. And you can see some stocks like Palantir as kind of AI stocks, which are trading at crazy multiples of earnings, 600-700 times earnings. It seems quite extraordinary. Can you reflect on that briefly?
Yeah, well, I mean, this comes down to what are we doing about it, and this is where the way Nick and Costa manage the portfolios is fantastic, because what we're able to do is we take the funds that we own, look through to the stocks that they own, and then put the portfolio together, and we can see immediately, where we've got different allocations to the world index. So I know that we don't have any Tesla in the portfolio, Nick, but you could maybe give us a few quick pointers on where we're different to the MSCI World Index and why that might give us some protection.
Yeah, sure. So as mentioned, the highly valued areas of the market are the hyperscalers, the Magnificent Seven, these large US tech stocks. Yeah, to give you an idea, their weighting in the MSCI ACWI index is currently around 25%. And when you put a Tideway portfolio versus that, our portfolio is around 1 or 2%. So we have a huge underweight in this area. And so if everyone is concerned about a market crash based purely on valuations, we're just not in that part of the market. So if you look at what's done well this year, it has been these hyperscalers, it has been the Magnificent Seven, it's been the profitless tech in the Nasdaq, and yeah, we don't own any of that. So if that is the concern, we are not there. What we do hold is the cheaper end of the market. So if you think what's done very well this year, apart from the US tech, it's been in areas such as banks. So elevated net interest margins from higher for longer interest rates has been good for their bottom line. Obviously, commodities, which we'll come on to later, including gold, has been very good. Plus, I'd say, and this is one of the major differences versus, well, in the last 10 years, our global managers are now, with the weaker US dollar, starting to allocate over to emerging markets and Asia a lot more. So I'd say on a portfolio basis, our equity portfolio is a lot more diversified regionally, doesn't have this large tech exposure, and is on a PE basis roughly 25% cheaper. So yeah, coming back to the valuation point, I think just on that part alone, we're well insulated.
But just on that tech issue, we were talking the other day. I mean, please don't think that we have our head in the sand and being Luddite about AI, because we're not. We absolutely can see what's happening and the spend going on in AI, and I'm pretty convinced that there's enough light at the end of the tunnel for these big companies to keep plowing the money in. I don't think they're going to stop anytime soon. And what a lot of our managers are doing is following that kind of supply chain of AI spending and picking up companies along the supply chain rather than necessarily Amazon or Microsoft, but they're going into data center energy, and in the semiconductor space, okay, we don't have such a big exposure to Nvidia, but we do have a big exposure to TSM, to Taiwan Semiconductors, which ultimately we know still is at the bottom of all these semiconductors is coming from.
So we can be nervous about AI stocks, but we're very excited about the opportunities that AI is.
There's no doubt, and T.S. Lombard have written about this today. There's no doubt that the spending on AI is boosting the economy in the US, and it will boost. So the immediate reaction is to think, oh, AI and the efficiencies is what going to improve the economy. But actually, it's not so much that at the moment. It's how much money is being spent, invested, if you like, by the Magnificent Seven, the big cash generators, into AI is filtering out through the whole economy. So it's a massive boom for the globe, really, around computing. Everything that goes with it, which is a massive piece of the market.
And that's just in equities.
That's just in equities.
Not our only asset class. So other risk mitigation controls that we put in place, like we pleaded during Liberation Day, we constantly have our risk management hats on. We're not looking after the event after the market has crashed to build defensive positions. We have those on already. So on the fixed income side, we have kept duration relatively limited, which has worked out quite nicely as the yield curve has steepened. Our active managers have done well picking their credits, especially during periods of market volatility, as we saw earlier in the year. So that's really helped them. So, and finally, we've avoided the areas of the market which typically now have the most debt. Ironically, governments being in there, but as you'll have no doubt have seen this week, we've avoided the temptation to invest in private assets with First Brands as part of a private credit portfolios blowing up. So to reiterate there, we have kept in areas of the market which we are comfortable with, not taking excessive risk, and we're happy with.
So I think to summarize, we're not going to go to cash. That's we are great believers in staying invested, but we have de-risked the portfolio in terms of the equity exposure. We're very we can see we can see exactly what's going on with the bubbles, but you have to be very careful with equity markets because you can be out. The market can be irrational. It may appear to be irrational for quite a long time, and this year it's looked expensive all year, but we've got some terrific returns out of other areas of the market, rather than necessarily being in those big US techs.
And that leads on to the second part of the agenda, which relates to performance and strategy. The question really is, you alluded to the fact that we've had strong performance so far this year across all our portfolios, it has to be added. The question is, can it be maintained? And I'd like to add to that, if you could, Nick, when you're discussing the funds and the different asset classes, to what extent do you see fixed income as interesting in terms of the yields that we're getting there, but also in terms of the opportunity sets within different parts of the global equity markets, because we are investing right across the world.
Yeah, nice broad question there. Compliance disclaimer out of the way. To get the compliance disclaimer out of the way, obviously the future is unknowable, but as we have spent a good portion of the first part of this webinar discussing that we think there is plenty to go in areas of the equity markets we are investing. Their valuations are not high, earnings growth is still coming through, and we think the environment will continue to be supportive of that. That we mentioned the various sectors which have done very well, but that's also ignoring the fact that our managers themselves have been very active and have picked some good companies. So it's not just broad themes, but what they have done is they have turned over their own books. So when prices have gotten higher and companies which they invested in have hit their target prices, they've sold out and they've recycled their capital. So even though it may look like we haven't done an awful lot with the book this year, there's been a lot going on behind the scenes. So in terms of whether I think that can continue on the equity side, I mean, compliance disclaimer aside, absolutely I'd be positive in those areas. I see nothing, obviously I'd see nothing to stop that continuing. in the near future. Fixed income side is a little bit more nuanced. I'm sure James will jump in here.
I was going to add around. We had a great example come up. We've had some questions about gold, and we don't hold any physical gold other than through Rafa, but we had 11 companies we noticed that have doubled in value in 2025, and I think 5 of them were gold miners. And what was interesting there is that we saw a piece recently is that their price earnings have actually come down, not gone up, because the price of gold has meant that their revenues and profits are increasing faster than their share prices increased. So although we've had double, 100% return on some of those stocks in 2025 so far, during that period they've actually got cheaper relative to their revenues and profits because the price of gold has gone up so much. So there's nothing to suggest that those are about to suddenly, if there was a big knockoff in the price of gold, we might see them adjust back down. But if gold stays reasonably firm, we can see those prices going up further.
Valuations are still reasonable.
Yes, we don't need the price of gold to go up. We just need it to stay roughly, within plus or minus 20 or 30% to the current band for them to make quite a lot of money.
But going on to fixed income,
yes,
credit spreads obviously tightening, especially investment grade. Does that mean that the returns going forward are going to be more limited?
Well, a good barometer of future returns in fixed income is the starting yield you have. There is a high correlation there. It's also a product of the defaults out there potentially in the market. We don't think that's the environment we're in. Perversely, market volatility is actually a very good thing in our fixed income credit portfolios. It gives the manager, if there is dispersion in the credits, it gives the manager an opportunity to actively trade the book, find areas of the markets which have sold off unduly, and sell the areas which have held up. So if there was no movement in credit spreads or government bond yields over the year, and there were market level defaults, you would get your starting yield as return. But what's happened this year, obviously during April, during Liberation Day, I mean, there was significant spread movement for a few weeks in the high yield market, which allowed active managers to trade their book and do quite well. So what I'd add to your question there is yields are higher than they were at the beginning of the year in fixed income books. They're there or thereabouts, despite the fact that credit spreads have tightened. Obviously, the government bond element has risen to such an extent that they're more or less level, and we can talk about that more later.
Yeah. So I mean, my take on it is that unlike base rates, which are slowly coming down, although there's question mark as to how much further they'll come down, with the longer duration bonds, so when we're lending money to governments beyond 10 years, the yield has actually been going up, so the prices of bonds have been falling. So that's a good reason why we haven't been in those long duration bonds, but it also means that the yields that are coming down the pipe to us are more juicy, so we're getting bigger yields. And as Nick says, we get these active managers who seem to be able to do on a fairly recurring basis, make more than the yields to maturity through various active management techniques. So we get the starting yield plus the premium that the manager throws up, and that still looks to us like a pretty attractive number relative to inflation at the moment. So inflation is proving quite tricky to get rid of, but it's under 4% broadly. And we're seeing roughly double that in our high yield managers. Which is a good real return for those who are very, are nervous about the equity markets, or as we'll come on to in a bit, have got a relatively short investment time horizon and maybe don't have the decade to recover from an equity market crisis. Then the fixed income still looks very attractive to us.
Yeah, when your long-term equity returns are 10 and you get 7 from fixed income, I mean, it's
with the prices of equities rising generally, we're seeing from various market commentators is that they're viewing the future return from equities, because you were starting at such a high level, has actually been quite low now, and therefore the bond return has come up level with it. Now, if you're basically saying you're going to get the same 9% from bonds or equities, you take bonds every time because it's less volatile.
Nevertheless, are we making any changes, Nick? on that basis in terms of managers.
Well, we can address the other point which was raised, which is why do we have so many negative returning funds? Well, actually, we don't have so many. We have a few, but
why do we hold negative performing funds?
Go on.
Just sell them as soon as they.
No, we have made some changes in the last few days, so maybe we just recap that quickly. So we have, over the last few days, we've sold our listed real estate fund, and with the proceeds, we've bought more of our listed infrastructure fund, Clearbridge Global Infrastructure. And yeah, the reason we've done that is to provide additional inflation protection in the portfolio. So a lot of the revenues from Global Infrastructure Fund are linked to essential services, and those are based off regulated assets, and see the regulator basically appoints what returns they can get in the future, and these are often, although lagged, inflation linked. So we think, obviously, an example of the secular trend here with the data center build outs, more power is needed, or an upgrade to the electric grid, for example, where they will need to invest and they'll be allowed to get a return.
And with the exception of data centers, where there's still quite a buoyant market, the rest of the real estate market looks pretty gloomy to us. I mean, we don't see any positive catalysts for that market at the moment, and it's been pretty.
For me, it's
pretty boring.
For me, it's a bit more nuanced, but I think the list of infrastructure story is really good. So I think it's more that for us, and that has done very well this year. And in inflationary periods, real assets, i.e., infrastructure, have done well.
We're still here in Leadenhall,
yeah,
and our 50-story block has not been built over the top of us. So that tells you something about the market for real estate in the city is probably a little bit cooler than this.
So on negative performing funds, I think the lesson here, which we found out in the past, is past performance is no guide to future returns, and so I think it's been academically proven just selling and buying funds based off of poor performance and strong performance is a losing trade, and essentially the reason is mean reversion. So if you get short-term underperformance in a fund, you actually have to know why it's underperformed rather than selling it. And
there was a big.
There's many examples in our portfolio where if like Artemis Global Income being the main example, where we've held it 7 years, and there was an opportunity 6 years ago to sell it after a period of poor performance. We did the work on it and decided that it was actually the manager could not have done a lot about the conditions at the time, and we were happy to keep it. We did the work, and rather than selling blindly, we held on to it. And obviously, post 2020 and COVID, and obviously war in the West, conditions have changed. That manager has now been top of his sector for the last 3 years consecutively, and I think he's returned 90% over the last 3 years. So those calls to sell the fund, I mean, it's quite tempting to listen to them sometimes and go into.
But let's be clear, what we do is, if we will look at a fund that isn't performing. Now, if the whole bit of the market that they're involved in isn't performing, then we're going to be more relaxed than if everybody else is doing well and they're doing really badly. In other words, they're missing the opportunities, and we will be quite ruthless if we think that somebody is doing badly, whereas other funds that we could own in a similar strategy or a similar area of the market are doing a lot better. So we're not wedded to them. We will cut if we feel that's appropriate.
Very good. The next part, performance, the final part related to investment side before we go to financial advice briefly. We talk about asset classes and portfolio construction. And I think it's a really interesting question to start off with. What is actually lower risk in terms of volatility and performance between our multi-asset funds? Is it fixed income, the ones focused on fixed income, or actually our multi-asset strategies? And they include RUFA. We made a brief mention of RUFA earlier. Perhaps we can go into a bit more detail on that fund, but also just generally on the funds, the fund of funds themselves.
Do you want to start, James, and I'll cover RUFA?
Well, having got the question in, I did ask Costa to do us some numbers, and in the dress rehearsal, i.e. in the Liberation Day fall-off, it was very clear that our bond portfolios fell off less than our multi-asset portfolios. So our bond portfolios were down minus 0.3 to minus 1.47 in the order of kind of risk. But our lowest risk multi-asset portfolio was down 1.66, so that was more than our highest risk bond portfolio. Then all the multi-asset portfolios sort of fell as you would expect on a risk basis, and the equities were down, 9.4 in our blended portfolio and 9.5 in our equity income portfolio. So on the downside, there's no question that the pure fixed income portfolios are more defensive, I think, than the multi-asset portfolios in the short term. Obviously, on the recovery, when things went back to the races, it's completely the reverse, and our equity income portfolio has recovered 32% since the end of the sell-off, whereas our lowest risk portfolio is only up 4%. But the lowest risk portfolio is on track to deliver 6% this year, which, for a cash plus fund, which only was down 0.3 during the crisis, during a heavy sell-off, it kind of feels like it's doing what it should do on the tin. What I would also raise is the fact that time horizon is quite important here. So if you're worried about inflation, then the multi-asset portfolios in the long term are probably lower risk than the bond portfolios, certainly the two lower risk ones. Maybe the high yield one kind of bridges the gap, but the multi-asset portfolios have equities in them, and they have real assets, the infrastructure that Nick is talking about, which are there to try and protect us against inflation over the long haul. So sitting in our low risk bond funds for a long period of time is going to be bad news in terms of your real returns. And I think, that's why we've got the difference between the two.
Agreed.
Did you want to talk about Ruffer very briefly? Because that was also listed in, we had a question that asked about Ruffer in that section.
Yeah, so I think the specific question was something along the lines of, with market valuations being higher, does it make sense to hold more Ruffer? And my answer, of course, is going to be yes. As obviously being, again, the risk management aspect.
And is it our biggest holding?
It's close to our biggest holding. So in multi-asset portfolios, the range of weightings is between 6 and 11%, again, depending on how risk averse you are. And just to provide context, obviously market crashes, there have been roughly 4 or 5 since their large ones since their inception in 1996, and Ruffer have never missed one of those. So .com, they outperformed the market massively during the global financial crisis as well, positive returns again. COVID, positive returns, and again, rate rises in 2022, again, positive returns. So if this is what, if a crash worries you, then it is nice to have some Ruffer. And I will also point out, in a strong year this year for markets, Ruffer has also done some heavy lifting for us there, and it's just shy of return just shy of 10% year to date. So
this came up in a conversation I've literally just come off the call from a new prospect client who was saying, one of his worries was that the fixed income assets, and he was really talking about owning government bonds, aren't anymore being negatively correlated necessarily to equities. So what happened in 2022 was that we had a sell-off in bonds and equities at the same time, and so people got mullered whether they were in bonds or equities. It didn't really matter. And the one thing we know about Ruffer is it's likely to be highly uncorrelated to equity markets. So we think in a big sell-off in equities, it would probably go up quite a lot more than bonds would do. It depends why the sell-off as to whether the bonds are going to go up or down. So if we had and tell me if I get this wrong, Nick, but if we had a recessionary type hit where suddenly there's a recession in the US and earnings look, economy slowing, and interest rates are likely to go down, bonds are likely to go up. But if we have another kind of inflation is taking off, bond yields going up at the back end, if we have that kind of hit, which we kind of had in
this cost push inflation, negative supply shock.
There you go. Those are the technical terms for it. So you get different types of market crashes, and in some cases it's good to own bonds, in some cases not good to own bonds. In any crash, I think it's good to own Ruffer. So on the basis of the poll, and on the basis that we think there's probably still a 50-50 chance of a sell-off, we should hold on to our Ruffer holdings.
And it's interesting, it wasn't so long ago that there were big question marks as to the Ruffer holding.
Yeah.
2
We
or 3
did-
years ago when it wasn't.
We have interestingly had quite a lot of Ruffer clients coming to us because they've been pretty fed up with Ruffer's performance until this year. And I don't think Ruffer is a solution, a total solution for an investor. I think that they're great as we hold them as an insurance, as a negative correlated asset, and hopefully don't cost you too much in the long term. But in a bull market, they are going to cost you, and have historically cost a lot to be in. Anyway, that's enough on Ruffer.
So moving on, talking about various different themes and commodities, we have talked actually quite a lot about AI, so you might not want to carry on too much on that subject. Nevertheless, the old chestnut gold is coming up, and this week it went through $4,000, I believe. So
yeah, so just covering off the AI point, I mean, we are aware of, there are a couple of one, maybe two specialist AI funds. I don't think they're for us, frankly, because they are going to include all the very speculative stuff. And we're much happier to let our global managers pick the AI exposure that they want through the value chain, as we've talked about. So that kind of deals with that. The gold, yes, gold through 4,000.
4,000.
Yes.
James, why are we holding gold?
Well,
as a wealth manager, many wealth managers do hold gold.
So here's a really interesting thing. So I had a long conversation about this. If you want to hold gold, I think you should hold gold yourselves personally, not through us. And the reason is that with gold, there's absolutely nothing to go on, right? So there's no maths we can do. We can't say it's cheap now than it was last year. Well, apart from the obvious price, but there's no underlying profit. There's no fundamentals to why gold goes up in price or down in price. So as a manager, we have no bloody clue, excuse my French, as to whether it's going to go up or down, is the brutal honest. So don't pay us a fee for owning something that we really don't know whether it's going to go up or down, would be my advice. If you want to own gold, and I don't necessarily think it's a bad thing to have some gold, I would recommend you buy some gold personally. And I always quote one of our clients who's buried it in the garden. So if you want gold as a last resort, if things are going really badly, then you want your gold easily accessible and not in a electronic ETF form that probably won't work on the day you need it. So he's got it buried, or he refuses to tell me where it is. But so owning some physical gold, perhaps, and having it either in a safe or buried in your estate somewhere, is quite good. But what we do have is exposure, as we've discussed earlier, to gold miners. And there, of course, we can do maths because we can see what price earnings ratio they're on. And they were very unloved. I mean, gold miners and commodity companies have got to a rock bottom price. So they've been we've seen them pop up in the emerging market funds, but we've also seen them pop up in the value funds because they were, classic value plays. I didn't really want to say anything about that, Nick, but I've said it all probably.
No, that's about right. Yeah, nothing really to add.
So
from a fundamental perspective, there was real logic in buying the gold miners. I think.
Yeah, and I think, dare I say it, gold and Bitcoin come into the same bucket, really, which is to say, there are arguments for them. I'm not necessarily convinced about either of the arguments for holding them long term, but they have proved historically to be quite good holders of value. And there's this whole idea that governments are basically depreciating their currencies over time, and it's a way to get rid of the debts, which we're going to talk about in a second. And therefore, you want to own real assets, and gold and Bitcoin might end up being things to do. But if you want them, my suggestion is you buy them yourselves, do it yourself. And in the case of AI, you definitely won't be able to, if there's a big crisis, you definitely won't be able to get hold of your Bitcoin, it'll be gone. So gold is probably the one thing that you can stick in the garden and go and pick up in really bad times.
Of course. Right. So that concludes, I think, hopefully reassures a number of investors and hopefully excites them maybe a little bit prospects who are coming in thinking, what is the opportunity set? Certainly the portfolios have been performed exceptionally, but they're structured to be resilient in case of any market downfall or significant correction. I mentioned briefly that we would discuss financial advice. There were a number of questions. We obviously have a budget coming up and another budget coming up in November. James, would you like to run through the types of questions we've got?
Yeah, well, they're on the screen there. People have asked questions. Clearly, inheritance tax But estate planning is in everybody's minds. Pensions and inheritance tax is a big issue, and the demand for offshore bonds and people searching for offshore bonds on our website has gone up. So we can see that people are looking for tax shelters generally. We're all a bit fearful of the November budget because we know what the pressures are. The government's got to try and cut costs and try and raise taxes, and it seems that politicians these days aren't really very good at cutting costs, so they try and raise more taxes. And it's almost like we're all worried about where it's going to bite next, and I think it is going to bite somewhere, but we're not going to speculate today on where it bites. Suffice to say, it's getting a bigger and bigger issue. The stakes are rising. We've always tried to think about your after-tax dollar, as you like. So it's all well and good making a load of money, but if you pay a load of tax on it, that's not so clever. So, it is financial or wealth management, combining those two, investment management and planning for tax, is what we think we're pretty good at. So I'd ask you to talk to your wealth managers about this stuff as we go along. We will come back after the budget and try and disseminate that and tell you what we think, if there's any big changes to make. The only thing that we have flagged up to a few people, I did it on the call this afternoon, is this issue of pension tax-free cashes. And I think if you've got a large tax-free cash entitlement, let's say more than £150,000, whether or not you need it at the moment, you might sleep easier on budget day if you took it out rather than waited. And don't leave it too late, because the pension companies always get inundated with requests to do that. So if you have got a big tax-free cash and you haven't taken it, it just seems to me it's such a big tax break. Why would you risk it around the budget given what's going on?
Very good.
We will come back to in November.
So you're advising our clients to take money out of pensions if they've got.
We've mostly done it. So we know exactly who's still got tax-free cash left, and in most cases, there's a very strong reason why they've got it, if they have still got it, for various reasons. But in the main, anybody who was sort of thinking about it would have done it by now if they're a Tideway customer.
Very good.
I hope.
Yeah, obviously, the tax environment is changing dramatically.
Yes.
So there's a lot to be done in that area. But as I said, we are predominantly talking about investment issues. Nevertheless, there's also the question of the business, and people are getting, I'd say not say concerned, but we've had a couple of questions on the basis that we've recently gone through a significant milestone, actually, £500 million of assets under management. And the concern is, James, that you might be thinking of retiring and selling the business as it's showing reasonable growth. It's looking good. So the question is directly to you now. I'm hoping you're going to answer this in the negative. But in any case, you're not going to retire.
I'm not going to retire,
Okay.
and I get a bit cross about it because nobody asked Jamie Dimon this yesterday down in Bournemouth, and I looked him up, and he's 69. So I've got years to go yet.
Yeah.
I have no intention. We've got no intention of doing anything in the business. We're really enjoying ourselves. The team's working really well. The investment process is better than it's ever been in my 40-year career, thanks to Nick and the team and the way that we're managing the whole investment management process. So we're really enjoying it and making hay, and we're going to run the business. I don't think I'll go on as far as Warren. We looked him up, 95. He's retired at 94. Bless him. But there's plenty more for me to do, so that's fine. Next,
very good. I guess it comes down to also the question of, ultimately, we seem to be doing very well. We're getting a nice lot of referrals. What is the value proposition? What is it, do you think, that investors are attracted by? Why do they stay with us? Is it the investment side? Is it the financial advice? Is it the service that we provide? Or is it all three, James?
I think it's a little bit of everything. We are very technology focused. We've got our portal. We're using AI already in various areas, and that's all about trying to improve our service. We try and be as affordable as possible. We're not going to be as affordable as a tracker, but right now there's very strong reasons why you don't want to track anything in fixed income or anything necessarily in equities. So the whole index versus active is where we can add value. And I think combining the tax planning and the investment advice together from a single source point. We know from talking to our customers that that's something that they like. And then I think, staying independent of, although we use AJ Bell as our custodian, we have a 3-year contract, which we renewed last year. We are looking at what's available out there constantly to see if there's a better solution. And if there was a better solution, we would move to it. So, we value our independence, and we value the fact that we're not, under pressure from a private equity firm or anything like that. I had a bit of a shock the other day. I was talking to my brother-in-law who sold his dental practice 3 years ago and had his last payment due from his private equity firm, and they offered him 15%
not to pay
it. And that just tells you, A, how much they're paying to borrow money in the venture private equity markets, and B, the pressure that they're going to put on these businesses that they bought in order to try and squeeze every last drop of cash out of them. So we're very happy that we don't have that weight, that huge millstone to carry around with us on a day-to-day basis. We don't have any of that, and we're enjoying, delivering our personal services.
And one of the direct questions actually linking into this issue of market crash is how would we communicate with our investors if there was a market crash? And I think
we'll do one of these.
It's instructive though that when COVID happened, that's when you instigated the bi-weekly or 2-weekly market insight. So we're communicating with investors every 2 weeks.
Well, we actually started every week.
It was every week.
And if we got into a really dramatic thing, I think if Nick was up for it, I would definitely go back to a weekly update, because I think there's nothing better than hearing that we're on top of things and we're watching what's going on. I think it calmed people's nerves down enormously. It proved so popular that we've kept it going. We stepped it back to every 2 weeks, otherwise Nick and I get a bit tired. But that regular communication and following the themes and talking about what's going on in the world, I think helps people rest a bit easier with their investments. So we definitely do that.
And we have instigated these webinars,
the webinars are good.
4 times a year.
Yeah.
But after the Trump tariff turmoil, we put in an emergency basically webinar straight after it. Now, there's no reason why we shouldn't do that in the future either.
And you can pick the phone up to us. I mean, both, Nick and I are both available, through the week. And if you want to talk to others. And
I think that's part of it, isn't it? The personal side. It does make a big difference.
Yeah.
Well, delighted to know that you're still staying with the business, James, and you will be for years to come. Now we need to get your crystal balls out, but before we do that, we're hoping to do another poll, just a bit of fun, reflecting on the extent to which individuals have exposure to earnings.
Well, let me
in their
introduce
holdings. Sorry, James, that's a bit of an intro.
This is a poll that actually came from a conversation with my wife Ursula last night on the train coming home, and she constantly doesn't understand or doesn't want to understand how somebody like Elon Musk can be kept being called the richest man in the world when all his value is in these paper shares which you can't sell. So she's always basically saying to me, you're not, it's what money you've got in the bank, it's what income you can generate, blah blah blah. So I thought, what would be interesting to know who owns shares in a business that generates the most profit, not how big is your market cap value of the shares that you own, but how much income do you collect each year through the ownership of those shares. So I went onto the internet last night and it couldn't give me the answer, and it's not freely available. So we got Costa on it this morning, and he spent a number of hours.
It's freely available information, but Costa just looked a little bit harder.
The information is there, but nobody's actually pulled it together. That was an obvious piece of work that we could pull in to tell us. So we've given you 1, 2, 3, 4, 5, 6, 7 individuals. There's a bit of a ringer in there, which is King Salman, who is the current head of the Saudi royal family. He has a bit of an advantage because he owns a country. We're not sure. Well, actually, Edna says that although it's not official, who was it in Venezuela?
Nicolás Maduro.
The man in Venezuela owns the country as well. And possibly Putin owns Russia, but we don't really know for sure. But the Saudis are quite open about it. They do own the country and the government. So I can tell you straight up, he owns the most income. But I will quickly run through. So Larry Ellison, for those who don't know who these people are, Larry Ellison owns 41% of Oracle. Elon Musk owns 15% of Tesla, 40% of SpaceX, and 74% of XAI. He's got three big businesses. SpaceX and XAI are not listed, so you have to dig around a bit to find their earnings. Warren Buffett owns 14% of Berkshire Hathaway. The Saudi royal family, through their ownership of the government and the sovereign wealth fund, own 97.48% of Saudi Aramco, which is obviously the biggest oil company in the world. Jeff Bezos, bless him, owns 8% only of Amazon, which is quite a big company. Mark Zuck owns 14% of Meta, or Facebook as we know it. And Bernard Arnault, the only Frenchman in the pack, owns 49% of LMVH. Now, what we're asking you is which one of those has the most earnings and as a result of their holdings.
Not earnings that they're paid out, but earnings that are.
I'm pleased to see that no one's put Elon Musk. That is the right answer. We give it a couple more minutes for people to vote.
I think we've got almost.
We've got a winner.
Up to 50, pretty much. Close.
Freeze it?
Mm-mm.
No, still coming in. Okay, let's end that. So the Tideway audience believes Warren Buffett has got the most earnings, followed by Frenchman Bernard, the King of Saudi Arabia. You're way out, guys. Larry Ellison, Jeff Bezos about equal with Jeff, just nudging it, and Mark Zuckerberg, you think is the poorest. Well, let me tell you. So when we multiply out their earnings by the profits of their businesses, the king of Saudi Arabia comes out by a factor of 10 at 98 billion a year.
Yes, more than everybody else put together.
Yeah, and more than everybody else put together. But we're not too sure, how much of that goes into his personal pocket. So he's a bit of a ringer. Mark Zuckerberg is actually top of the list. And when you multiply his earnings in Facebook by his 13.6, he makes about 9.76 billion a year in net earnings. If you compare that with Elon Musk, we think Elon Musk are less than $1 billion. So Mark Zuckerberg is almost 10 times Elon Musk in terms of earnings. Going down the list, you were quite right that Bernard Arnault is up there. He's got 6.44. We think we didn't put him on the list, but we think the Walton family that owns Walmart are in there at 9 billion. These are. Warren is quite close to the top. He's at 6.28. Jeff does pretty well at 5.8. Larry Ellison 5.25, so slightly under Jeff. I think we may have got them the other way around on the poll. And coming up the rear is old Elon, who is way off the pace at just 8.6.
Still not doing too badly. A reflection of the inequality that exists in the world. But we'd like to finish with, as I say, looking at the old crystal ball. You've asked a number of questions looking forward. We've classified them in three different ways. First of all, the US versus the UK economy, the outlooks for each. Who would like to take this on to start off with? Don't all shout out at once.
I could cover the government debt part. That part.
You do the government debt part first, and then I'll do the bit at the end.
Yeah, I think we also had a question in early on in the session, which reiterated this and why we're comfortable not holding government debt at the moment, despite the fact that yields have risen quite a lot. And yeah, the first part of the reason is obviously over the last 10 or so years, leverage has shifted from corporates and consumers over to governments. Obviously, that's been easy to see over the last few years. And so when the argument for owning, not owning corporates over governments now, where credit spreads are tight, I think obviously that is a natural outcome of that. Combined with the fact that corporates are a lot higher quality than they have been in the past, it's just another reason we're happy to hold them. And again, it's mentioned earlier in the piece by James why we hold rougher. governments without their negative correlation to risk assets are essentially adding risk, especially if they're long duration and the drivers are increasing inflation, creating more volatility, whilst you're actually giving up a return versus corporate. So even though spreads are relatively tight, we'd rather sit at the short end of the yield curve with a diversified bunch of active corporates being selected by managers, even if the spreads are tight. If there is a movement in credit spreads at the short end, we think we'll be relatively well insulated just from the duration.
It is the elephant in the room. I was quite pleased to read in the FT that Jamie Dimon was quite complimentary about Rachel Reeves' management of the UK economy yesterday. It's good to have some positive once in a while. But both the US and the UK, they've got those challenges around how they balance the deficits and fund the debt. It's going to be worked through. I mean, we've got the US government still shut, I believe, isn't it? So that's over debt financing, I think, isn't it? Or overspending, budget spending. So, both countries have got real problems. I think the US versus the UK economy, I wanted to just draw the distinction between the strengths and the look of the economies versus how the shares do. The two things aren't necessarily linked. And, just because the UK economy might not look as rosy as the US economy doesn't necessarily mean that UK shares won't do better or worse than US shares. And at the moment, particularly once we put the currency exchange rates in, the UK is winning that argument. But the most important thing I wanted to perhaps end with is just take you back to just before Christmas last year, when all the papers start doing their predictions for 2025. And it was universally that the S&P 500 and the US equity market was going to be the dominant return. The phrase TINA, there is no alternative but to pile into the US markets. And here we are sitting 9 months later, and actually, we've got 3 times the return in Korea than we have in some of the emerging markets than we've had in the US.
And a much higher return in the UK.
We've had a much higher return in the UK. We've got a higher return in Europe than we have in the US. And we've got very nice returns in Asia. So the big thing that I see, and it's coming through in what T.S. Lombard are writing, is that when they go out and talk to managers, and we met with one of our clients who runs the Ontario Teachers Pension Scheme, these big controllers of capital are looking outside of the US now much more than they were this time last year. There's definitely a mood swing, which is to say, we've got over allocated to equities, to the US markets, and we're now going to reposition. We're a bit nervous about the dollar, a bit nervous about Trump, we're a bit nervous about the budget deficit and the debt mountain in the US. And so, we're going to hold back on the US and invest elsewhere. And it's been that which has been the catalyst that's put the light under our portfolio performance, because we've always been more diversified, and that's what's fired up all our global fund managers.
So being more risk averse hasn't hurt returns. In fact, it's probably helped them.
Well, it's been a double whammy. We've hopefully taken less risk, but we've actually got more return as well.
So on that point, I'd like to bring things to a close. I think we've got about 30 seconds to go, or our allotted time. Just to say thank you very much for your attendance. Thank you in particular for sending so many questions through. That was a record number. We tried our best to answer them by ordering them accordingly, but appreciate that some people might want some more information regarding specific questions that they asked. Please feel free to email them again to your wealth advisor. In the meantime, we're looking forward to hopefully to seeing you again, to receiving more questions, but with respect to financial advice, and in particular with respect to the budget. It'll be, the next webinar will be just after the next budget at the end of November. So once again, many thanks for your time tonight, and we look forward to seeing you at the end of November, when we'll be reflecting a little bit, no doubt, on investment performance and whether the markets have actually taken a dive or not. But once again, many thanks.